Disclaimer: this video features AI-generated audio-visual content. Investments are subject to market risks. Please do your own research or consult a registered financial advisor. Heading into the March 27th trading session, the Indian market is facing a significant divergence. While global macroeconomic data is rapidly deteriorating, domestic indices are showing a level of resilience that contradicts the international headlines. The primary external threat is the severe geopolitical escalation in the Middle East, where infrastructure damage is now impacting core regional operations. This instability has caused Brent crude prices to react sharply, violently spiking past the $101 per barrel threshold in a single trading session. Adding to the tension is the increased visibility of U.S. military assets, with naval warships repositioning toward the Strait of Hormuz to secure energy routes. Despite these significant crash catalysts, the Indian market is not following the global script. Domestic indices are successfully defending critical technical support levels. Entering tomorrow's session with a directional short bias based solely on global news overlooks the specific domestic mechanics currently driving the market. The force currently overriding the macro data is aggressive buying by domestic institutional investors, or DIIs. This activity is primarily driven by year-end net asset value management. Mutual fund managers are required to report their performance at the close of the financial year. To protect yearly return metrics, DIIs deploy massive cash reserves, absorbing selling pressure to pull the market higher. This structural buying creates a temporary floor under the indices, defying traditional indicators of weakness. However, once these performance figures are finalized, this institutional support is no longer guaranteed. The buying force currently propping up the market could exit just as quickly as it arrived. To navigate this environment, you must stop reacting to the global news flow and start executing at the specific mathematical levels where this institutional capital is being deployed. We can identify where these institutions are leaning by examining the current participant positioning in the futures and options market. The data shows retail traders have built massive net short positions, trading on the assumption that geopolitical conflict must lead to an immediate market crash. In contrast, DIIs remain heavily net long, using cash reserves to defend market levels. Foreign institutional investors are running a complex strategy, shorting futures to hedge macro risks while holding long call options. This creates a classic liquidity trap. Retail traders are positioned for a drop, while institutions have hedged themselves to benefit from a sudden upward squeeze. Because institutions are actively seeking retail liquidity, you must abandon directional biases and trade only within predefined technical zones. For the Nifty 50, our analysis begins at the current closing level of 23,306. The upside trigger is clear. Do not initiate long positions until the index achieves a confirmed 15-minute bullish close above 23,370. If that level holds, scale in your position. Increase to medium quantity above 23,445 and move to a full-sized position only once the index breaks 23,500. The ultimate upside target and the point of a structural trend reversal is 23,800.
On the downside, the immediate support zone to monitor is 23,270. A failure to maintain 23,270 opens a high probability drop toward the 23,150 zone. The absolute capitulation point is 22,980, which marks the structural breakdown trigger is 52,905. Consider heavy short scaling only if this floor is breached. Bank Nifty's current premium levels are significantly elevated. Execution must occur strictly at these specific zones to account for the rapid theta decay and stop hunts. The execution plan for the Sensex begins at the 75,200 closing level. Look for a sustained move above 75,300 to begin initiating longs. Scale your position to medium quantity at 75,500 and commit to full size only upon breaking 75,600. The downside risk profile is dominated by a major technical and psychological floor at exactly 75,000. If the 75,000 level fails, the index enters a liquidity void with little historical support. A breakdown of that floor opens a potential dropdown to the 74,350 level. Sensex offers the cleanest technical lines in the current market, but the 75,000 floor represents the final structural defense before a significant liquidity drop. Beyond the charts, we must address the structural risks of the upcoming session, starting with the compressed holiday expiry cycle.
This chart shows a typical theta curve, measuring the rate of time decay in options. Because of the shortened trading week, these premiums will erode aggressively starting tomorrow morning. There is also significant risk of carrying unhedged positions over the weekend, especially with unpredictable geopolitical news flow coming out of the Middle East. Sudden policy announcements or shifts in U.S. military strategy over the weekend can cause indices to gap aggressively in either direction when the market reopens. Holding directional, unhedged options over this specific weekend is a form of speculation that falls outside of professional risk management. To manage the inevitable volatility, Rule 1 is to reduce standard position sizing by 50%. Rule 2, trade the mapped technical levels we have established and disregard the noise of the news cycle. Wait for the 15-minute candle to close before executing any trade to ensure level confirmation. If valuable, please like the video, share with your network, and subscribe to Vidhan Lakshmi for continued institutional analysis. Please review the final legal and AI disclosures displayed on your screen. Institutional traders survive by executing strictly on verified data points. Base decisions on mapped levels, not headlines. Stay safe and trade the levels.